So you're serious about trading? Well, like any professional, you need a blueprint before you start building. That's exactly what we're going to lay out right now, a foundational guide to how the financial markets really work. Let's get into it.
Here's the plan. We're going to start with the big picture, the trading arena itself, and then we'll meet the key players. After that, we'll look at the 24-hour clock to pinpoint the absolute best times to trade. We'll learn the lingo, and then we'll put it all together to build your foundation. All right, first things first. We have to understand the fundamental physics of the market. I'm talking about the core engine that drives every single price move you will ever see. So what even is a market? At its heart, just think of it as this massive electronic meeting place. It's not a physical building, right? It's a global network where buyers and sellers from all over the world can trade assets instantly. This is the arena. And you know what? This right here is the one principle that governs absolutely everything: supply and demand. It's simple, really. If more people want to buy something than sell it, the price has to go up. It's like trying to get tickets to a sold-out concert. Tons of demand, few tickets, price skyrockets. And on the flip side, if way more people are selling than buying, the price drops. Every chart, every pattern you'll ever analyze is just a picture of this constant tug-of-war. Okay, so a market isn't just some abstract machine. It's made up of people and institutions. And if you want to trade like a pro, you have to know who else is sitting at the table with you. You've got to understand their moves. And here they are, the key players. You've got the central banks at the top. These are the heavyweights. Their decisions on things like interest rates can literally shake the entire global market. As a pro, you don't trade when they talk, you listen. Then you have the huge commercial banks, moving massive volumes and providing the liquidity that keeps everything flowing. Hedge funds, they're the ones using complex strategies that can pour gasoline on a fire, amplifying trends. You also have corporations who are just in the market for business reasons, maybe hedging against currency fluctuations. And then there's us, the retail traders. We might be small individually, but together our collective action is a growing force that adds real depth to the markets. So you know the arena, you know the players. The next question is, when's the best time to get in the game? See, the market runs 24 hours a day, but not all hours are created equal. This is about being efficient, about trading smarter, not harder. The global trading day is kind of like a relay race. It kicks off in Sydney, which then passes the baton to Tokyo. Next up, London comes online, that's a huge one. And finally, New York opens for business. The real magic, though, happens when these sessions overlap. And that overlap brings us to this critical window. For just 4 hours a day, from 8 a.m. to 12 p.m. Eastern Time, the two biggest financial centers on the planet, London and New York, are open at the exact same time. This, right here, is the market's prime time. And why is this window so important? Because this is when the big money is moving. It's when the major institutions are most active, when trading volume is through the roof, and when most of the big economic news drops. For a professional trader, this 4-hour slot is where the biggest opportunities for major price moves happen. All right, we're getting close. Now, to operate in this professional arena, you gotta speak the language. Let's quickly nail down the 4 essential terms you just have to know. No exceptions. First up, the pip. It's the most basic unit of measurement. It's the smallest, standardized move a price can make. Think of it like inches on a ruler. All your profits and losses are going to be measured in pips. Next, we have the spread. This is just the tiny difference between the buy price and the sell price. You can think of it as the cost of doing business, the transaction fee for placing a trade. The tighter the spread, the better it is for you. A lot is all about size. It's a standard unit that tells you how big your trade is. Whether you use a standard, mini, or micro lot will decide how much money each one of those pip moves is actually worth. This is how you manage your risk. And finally, leverage. This is a tool that lets you control a much larger position with a smaller amount of your own capital. It's a powerful amplifier, but, and this is a big but, it amplifies everything, both your wins and your losses. And that brings us to this, which is so important to understand. Leverage is a double-edged sword. It's an amazing tool when you're right, but it will magnify your losses just as fast, if not faster, when you're wrong. A small move against you can do serious damage if you don't respect the power of leverage. So there we go. We've now covered all the core components. Let's take a step back and see the full blueprint that we've just assembled for your trading foundation. And here it is, the 4 pillars. You've got the engine, that's supply and demand. You've got the players, knowing who's at the table. You've got the clock, identifying those peak trading hours. And you've got the language, mastering the core terms. This is your foundation. This is your blueprint.
Look, this knowledge is the bedrock of any serious trading career. It gives you the ability to see the market with more clarity and to act with more discipline. So, the only question that's left is, now that you have the blueprint, what are you going to build?